Hello, everyone, and welcome to RealAlt Investments webinar today, hosted by Six. Today's event is titled Real Estate Mortgage Investing 101, Building Wealth Through Diversification. We're joined today by the company's CFO, Shezan Mukadem. Shezan is a seasoned finance manager with more than 20 years of experience in accounting, account reconciliation, cash flow management, and investment management. He has experience conducting training through advocacy and mentoring of fund accountants on an ongoing basis. We're also joined by RealAlt's Senior Vice President of Marketing Communications, Tracey Dorr. Tracey's an industry vet with 25 years of sales and marketing experience. As a quick reminder, you can ask questions at any time during this event by accessing the chat panel on the right-hand side of the screen. And as always, this event is being recorded and will be available tomorrow for on-demand viewing, as well as posted to our YouTube channel. Without further ado, I'm going to pass it to Tracey and Shezan to load up their deck and get started.
Thank you.
While we're loading up the deck, actually, there is a quick question for the audience. Wondering if people in the chat can name all the categories of commercial real estate. Just eager to hear what people have to say. But otherwise, I'll pass it to Tracey and Shezan.
Thank you. Yes, that was my first question to the audience. If you can name as many categories as possible of commercial real estate, because I think you'll be surprised to see there's more than you realize. So you're joining us today for presentation number 3 of 5. So you've heard from Peter Friedman, our external advisor. You've heard from our CEO, Brian Dorr. And then today we're going to give you a brief overview over passive real estate investing. Okay, so for today, the presentation is about 25 minutes long. It's not too long. We're going to go over what passive real estate investing is and give you an overview of a REIT, a MIC, and a little bit about an LP-GP structure. We'll talk about what a mutual or mortgage fund trust is, and that is what RealAlt is. We have 10 questions we recommend you ask if you're going to look into a passive real estate investment, and we'll answer those questions from our fund standpoint. So I think everybody knows what active or direct real estate investing is, which is basically house flipping or owning a duplex or a vacation rental, multifamily properties there, but that has to be under 6 units to fall into residential real estate. So passive real estate investing is REITs, retail real estate investment trusts, MICs, mortgage investment corporations, LP-GP structure, which I'll speak about, and a mutual fund trust, and we're a mortgage fund trust, same category. There's also equity investing and crowdfunding, which we won't talk about today. So I am curious to see how many people got this right. So office buildings. So Romeo, I might have to ask you to see if anyone got all these right. Retail buildings. So this would be a large mall. 5+ unit multifamily residence, so apartment buildings. Mixed use. So maybe there's a retail plaza underneath and then condos above. Factories, which is in the industrial category, warehouses, vacant raw land, which is a lot of what we deal with, but for residential development, agricultural land. Did anyone get that answer? And special purpose, schools, churches, retirement homes. How did everyone do, Romeo?
We had one person come very close with office, industrial, retail, hotels, and mixed use. So BP, very close, very close. Everybody else named 1 or 2.
Okay, great.
That's about as close as we got.
That's great. So I put this slide up because the category is actually much, much larger than we perceive. Often when we hear statistics, it's about office buildings or retail and rents, etc. But it's actually a much broader category than that. So getting into passive real estate investing, this is a chart that we've just created internally, where I've just put together the different categories. We are a mortgage fund trust. This is our product. Here's the MIC, the REIT, and an equity fund. And then we have a series of descriptors to help us differentiate between each of them. For example, where's your money being invested? So mortgages and properties. REITs is about, that should say, investment income properties. Sorry, retail rental properties. I'll get into that in a minute. And equity is putting money in and then getting it out in 2 to 3 years with higher returns. So let's talk about a REIT. So REITs were created just in 1990. They're an entity that owns income producing, that's the word I was trying to say, income producing properties such as apartments, shopping malls, hotels, warehouses, and office buildings. So I've explained how the category is very broad. So REITs are an interesting category to invest in, but you have to be very aware of what's in their portfolio and where these products are located. They generally are owned versus developed and sold. The investors are getting returns on their investment from rental income. Again, pointing out to what is in the mix. If their particular mix has office buildings in downtown Toronto, we all know they're not doing so well right now, or in downtown Vancouver. REITs can be both public and private. It's our estimate that it's about a 50-50 split. Our industry has a lot of private investments. REITs, there are a number of them on the stock exchange. And like any category, these can have different variations. REIT ETF, a REIT mutual fund, a REIT hybrid with mortgages and owned. So there's always variations. So what type of returns do you get in each category? So in a mortgage fund, it's distributions. In a MIC, it's dividends, and then eventually profits at the end of the sale of the properties. So each of those have tax implications. So you need to also look into how that impacts your taxes, capital gains, etc. A MIC, a mortgage investment corporation, they were actually invented in 1973 in Canada. So you're investing in mortgages, but they have a very structured category. They invest in residential properties and maybe some other things. So part of the criteria for a mortgage investment corporation is it has to be Canadian. It has to be 50% of its properties in residential homes, so mortgages in homes. They can only own up to a maximum of 25% of properties. They don't pay taxes. I'm coming to that in a moment. You can invest in public or private mix. What's another interesting thing about mix is they are required to pay all of their net income to the shareholders in the form of dividends. They don't pay taxes, so therefore the shareholders need to pay tax on that interest income. LP-GP structure, we do have a lot of these in our industry, and basically these are long-term investments where developers are fundraising, and they create a GP-LP structure, a limited partnership, general partnership structure, where you're putting your monies in for anywhere 3 to 5 years and sometimes longer, and then right now it's going to be longer. So the risks is high, but the returns are also high if you've invested in the right area. So these are also kind of complex legal arrangements that you would have with the developer. So you would really need to read that legal document in detail to understand what you're committing to. Okay, now a little bit about our category. So a mortgage fund trust, they're investment vehicles that lend the investors' money, a pool of investors' money, into commercial properties. And in this particular case, we lend to developers to help finance their land, for land servicing, and then into construction. So we have a threefold method of which we keep the mortgages going within our fund. Loans are secured by mortgages over the property, so that's your primary security. So should something go awry, you still have that tangible, the property is still there and it has value. Funds can be open-ended or closed-ended. We have a flexible investment structure. If we happen to have extra cash flow, we could potentially put it in a GIC if we wanted to, whereas a MIC, you cannot do that. We have an offering memorandum, or a fund can have offering memorandum or prospectus. These are very long, detailed documents, but have all the details of the fund. So going into a fund, you're spreading the risk because you have a pool of investments and a pool of investors. So should something not go well with the default, it's spread out over multiple mortgages, so the risk is minimized. But we have also various series and classes to diversify a little bit. So how it works, the structure is basically investors would invest money, and it's pooled money, and it goes to the fund manager, and the fund manager you met last week is Brian Dorr. He oversees that fund. They make choices on what funds they should go into. They have very in-depth detail underwriting to ensure the mortgage will be successful. The security is the mortgage. Mortgages, just like our home mortgages, have to be paid interest every single month. That interest then is generated and it is returned on a monthly basis, in our particular case, back to the investors, or the interest could be reinvested again. Now I will hand it over to Shezan to give a little more detail about RealAlt.
Thank you, Tracey. Thank you very much. Hello, everybody. As Tracey explained, we have a fund called RealAlt High Yield Mortgage Trust Fund. This fund was launched on April 2021, and we are right now in the capital raising mode for the fund. The basic structure behind the fund is we invest in all the land at Ontario province, and we have two kinds of investment. One is a debt investment, and one is an equity investment, which helps to diversify the risk across the board for all our investors. Next slide, I'm going to dive into what are the criteria and what are the important aspects of this fund, which helps the investor to understand better what we do as a fund manager. So these 10 questions which I have placed there, which will help you to understand what is the asset type of the fund, what locations, the net asset value, the loan to value, what is geographical concentration, types of mortgages, the performance history of the fund, the in-depth experience of the managers, and what is the minimum investment required. I do welcome any more further questions if anybody has, and I'm happy to answer those as well. What is the asset type? So basically, the assets are divided into various series. As Tracey explained, the Mortgage Trust Fund has various series and classes. So right now in our fund, we have two types of series. Series A for debt investments and Series M for equity investments. So let's dive into Series A, debt investments. Now, what is the asset type? We invest in land servicing, and new home constructions. What is the asset located? All of them are in Ontario. What's the fund's priority? Now, as an investment manager, our basic priority is to preserve capital, and we basically invest in those portfolios where 80% loan to value of the land or property, maximum. That is the risk exposure. But currently, our loan to value is much lower so that we could preserve the capital and give investors a good return on their portfolio investment. What is the net asset value? So in the last 2 years, we have raised approximately $24 million in the fund and fully deployed. There is no cash track. There is nothing on the fund which we hold on. So that way the investors reap the entire benefit of the fund. Loan to value. Now, the first question comes to mind, what is loan to value? Loan to value is basically the loan given to the value of the investment. Currently, we are holding at 57%, but as per our offering memorandum, we can go up to 80% maximum. So we're keeping it much lower, and this is the average across all our investments in the entire portfolio. What is the geographical location concentration, which we do Barrie, Dundalk, Tecumseh, Mississauga, Vaughan, Lindsay, Markham, Toronto. This is our diversification. Most of our concentration is in the suburbs of Toronto. As of August 31st, 2023, this is our schedule of investment. These are all the investments we have done in various locations, going from Dundalk to Toronto. And if you look at the loan type which we do, most of them we do in land and construction. Most of the concentration is in land rather than in construction because land retains its value. And the positions also which we are taking, most of them are first positions rather than second position, which is still a very conservative approach. And if you look at the extreme right-hand side, the loan size. So we do not fund the entire deal. If the loan size is $12 million, we have done 6. We have gone down to 3.5 compared to 37.5. We can preserve investor capital to make sure that they get a healthy return and the exposure is limited, which leads to immense amount of diversification in the portfolio. Now, what are the different types of mortgages? Earlier, when you saw the schedule of investments, you guys saw first mortgages, 58%, second mortgages, 42%. Land loan, as we have done, is 89%, and 11% is construction loan. So we are pretty much on a conservative basis, maintaining first mortgage position and land construction positions. Then what is the performance history of the fund? Now, if you are in the fund since inception, you're getting approximately 11% return since inception. Currently, the monthly annualized return is around 8%, which is a very healthy return in this market. So, and this is our entire portfolio yield. So if you look at the fund's return is 8.33, 13%, and the total portfolio size is 23.97 million. And my net asset value was 24 million, which clearly shows that the investors, that the full asset portfolio is completely deployed. There is no cash drag. And most of the managers have depth experience. The first seminar which we had was with Peter Friedman, our advisory board member, who comes from intense educational knowledge and experience. Then Brian Dorr, who is the investment manager. Next week, you're going to speak to one of our heads of underwritings. So we come with overall 75 years of experience in commercial real estate financing. Hence, we can decide what mortgages are good for our investors and what mortgages we should not put in the portfolio. Subsequent to that, we will talk about what is the minimum amount of investments. Now, the minimum amount of investments we are accepting in Series A is $25,000. And this can be invested in whatever shape or form. It can come through EMDs. It can go through your registered RRSP, TFSA accounts, and your open accounts. We accept high net worth individuals, accredited investors, investors who want to rely on the prospectus or the OM exemptions. So we have created across the board a lot of flexibility for any investors to put in any amount of money with a minimum of $25,000. Now we move on to Series M. Now, Series M is basically launched looking at the current market scenario and the market conditions. We decided to launch the series as an equity series. Now, what is an equity series? Equity series is a case where we go carve out a position or a purchase an equity in real estate. In that case, the investors are basically going to get 2x or a 5x return over a period of 3 to 5 years. Compared to a debt position where you're getting monthly cash flows. Out here, you don't get a monthly cash flow, but you get a return after 2 to 5 years on your investment. So why did we do this? The question is that. The reason we did this is because Series M and Series A leads to more diversification, and investor can cherry pick whichever series he wants to go into. So let's understand Series M more in detail. As I mentioned to you, an equity funding investment in distress, default, or power of sale properties for residential home developments or multifamily assets. Target projects, strong developers, strong premium locations. With high interest rate environment, now why we are doing this? Because a lot of defaults are happening, a lot of assets are going to be available in the market at a discounted price. So we took this as an opportunity to invest and say, you know what, we will launch Series M, and we will continue it. So we are planning the launch in Q3 2023. And over the coming months, when we raise capital, we'll go buy out these deals, which we are already looking into it. And with that, the reason we launched Series M is also because Brian Dorr, the investment manager, has immense default experience in most of the deals because he has gone through the entire cycle of the 1990s in default. So he's very well aware about what are the pitfalls and how do we overcome that. And that will add a lot of value to this series. Now, the type of fund, it is a monthly subscription fund, minimum investment of $25,000. Unit price is a monthly NAV price. We are targeting an average return of 2 to 4x on equity. Investment horizon is 3 to 5 years. And we are planning to launch this fund on September 30th so that when the investors want to put in money, they start with whatever money we get in, and then we start the fund. And then redemptions are going to be yearly. So with that, I conclude the overall understanding of the RealAlt investment fund. Please let me know if you have any more questions, like any more, I'm happy to answer. So yeah, this.
Thank you so much, Shezan and Tracey, for going through the presentation. We do have a number of questions, including some that came over on email, so I'll just run directly into those. And just as a reminder, especially for those who came in late, I noticed a number popped in later into the hour. You can use the chat function on the right-hand side of your screen to ask questions anytime. But let me get right into a couple. So some of these you had covered, so it might actually be worthwhile going back to that slide just to run through a couple of these. But the first one is from BP. They ask, can you rank the passive real estate types, mortgage trust, REIT, et cetera, in order of risk? They later note that they found it on the chart, but it might be good just to go through that again for the audience, if that's all right.
Yes, no problem. Okay, equity is your highest risk. Mortgage, fund, and mix are sort of equal. We're considered medium to high from a regulatory standpoint. And then REITs would be your lowest risk. And then with each of those, of course, your returns are same amount, highest returns and then the lowest returns.
Makes sense. Brad also asked, this is a pretty specific question, but I think it was also covered by the presentation, but let me know. He notes that REITs can be in TFSA and RSPs, but he wonders if all these products can be in those tax-free savings accounts.
Great question, and it depends on every single product. Like I said, there's private and there's public investments, and then privates you have to find out every single one if you can invest in those or not. I believe if you're in mining, you have to go through EMDs to invest, and your EMDs would know about these products and if they have TFSA or RSP eligibility.
I would also like to add to Tracey's comment. Every fund is very different. So it depends upon how the fund is structured by the investment manager. Yes, you can have the ability to invest in TFSAs, RSPs, open accounts. It all depends on the fund structure and what jurisdiction they're based on. But there is a possibility for sure.
Oh, I appreciate that. So Graham asks, and just obviously to the best of your ability, but he's curious of which of these investment products is best and worst protected against the very specific outcome of a Canadian housing crash.
That depends on the risk. How much risk are you ready to take, basically? It depends on your risk exposure analysis. If you want to take higher returns, then you do an LPGP structure where you get 2 or 5x and higher returns. It depends on your exposure of your other portfolios. What is it? It all depends.
It does. I will have an opinion because I think that's what they're looking for. So we just had a discussion the other day about mix. Mix have been doing very well. Well, mix, their primary investing structure is residential homes. Now, if a homeowner is going to a private lender for investing, it means there's likely some hurdle that they weren't able to overcome with the bank, so they're at a higher risk. So as our interest rates are going higher, all homeowners are worried about their interest rates. So I would say right now, mix, got to be concerned about. REITs are fascinating. I've been doing lots of reading on REITs. I particularly like the ones that have Walmarts in their lineups. That makes sense. The ones that have Canadian Tires. But the ones that have a lot of office space, they're risky. So that's my point of view.
Oh, appreciate that for sure. There's a bit of grumbling in the chat about anti-development governments and too many hoops to jump through. I'll leave that for the chat. You guys can fight it out there. Graham asks, what record does RealAlt's real estate mutual fund have over the last 1 year and 2 years?
Over the last 2 years, as I said to you, the Series A is the inception to date return is around 11%, and the year to date return is also around 8%. So from inception to date, 11% and 8% year to date.
Great. There was one question, and again, I think the presentation touched on this, but really, I guess we'll focus on the why of this question. They're looking to know what jurisdiction in Canada does RealAlt's various funds prefer to work in, and why. So I guess we saw where you tend to focus, but really the why, I guess, would be a question.
We are entitled to take subscription from all the jurisdictions except Quebec. So all the jurisdictions we are ready to accept, Alberta, BC, so we are fine to accept money in all the jurisdictions. So it's not a problem except Quebec.
And the why is just that there's so much opportunity in Ontario right now. We haven't maxed out or tapped out on that. And until we meet a certain threshold, we're not really looking outside the province until that happens. The population growth primarily will be in Ontario as well. And so our portfolio is land into residential homes, and our population is growing. So Ontario, we feel strongly, is the best bet for us until the fund reaches a certain level.
And that's in relation to the investments. But from the investor standpoint, we are not registered in Quebec because Quebec has different sets of regulations. We are happy to do that. It depends upon how much money an investor is planning to put into the fund. So it is possibility to do it.
Great. No, appreciate that. There's one question, and again, this is only to the best of your knowledge. Totally understand if we just pass on this question. But Brad asks, how much do your clients typically invest in your products compared to their overall net worth? It's only if known.
Yeah, and I don't think we can actually share that, can we?
Yeah, that's kind of a private information, and it depends on their EMDs, how much asset allocation they want to give it to us. So we will not, it depends. As I said, it can be 10%, 5%, 15% of their asset allocation can go in real estate, and the rest they can do it in mining or Bitcoin or public securities. So
I think it ranges, but if you're really interested, I would actually give our investment relations person a call. His name's Harshal. I can get you his information, and he'd be happy to give you have a general discussion about it, but probably give you a little bit more information than we can.
Yeah, sounds great. We'll make sure that we get back to you offline, Brad, just so we can get that question answered. There's another one. This is clearly from a junior mining investor. They say, you talk risk, but how much risk is there? It's junior mining can take big hits, LOL. What's the extreme downside risk in these products, and how common is this scenario in that happening over, let's say, the last decade?
Right. That's a great question, and I don't know a lot about mining, to be honest with you. And Romeo was just sort of briefing us even before the conversation. So, what's the risk? Okay, so our funds, before we launched the fund, we were doing syndicated investing. And what syndicated investing is here we have this mortgage, and it's on land, and it's a first mortgage, and your return will be 12%. And someone would say, oh, I'm going to come in and I'm going to invest $5 million in that. But I also want to cherry pick, and I also want to be the second mortgage on this construction loan and get 15% return. So the reason why we put the fund together was to spread out that risk. So your greatest risk is if that construction doesn't finish or the developer defaults, you lose all of that money. You have the potential of losing all of that money. Now, what will happen, because it's land and development, eventually the product will be sold off, and the hope is that you will get your capital back. But there is the risk you could lose your money. The reason why we go with a fund route is because you're spreading that risk out. So there's a lower probability because of regulatory and all that type of stuff. I can't say there's zero.
You're basically diversifying your risk in the fund. So let's say if one of the assets goes defaulted, not performing, but you will still get 8% or 7% or a 9% return because the rest of the 11 assets are performing in the fund. So that way, the impact, an individual's impact is much lower he's taking than on an overall basis when he's doing direct investments in one asset.
Oh, thank you. That makes sense. We only got time for a couple more questions, so keep in mind if we throw some more in, if you think of the perfect question to ask right after the event, as I often do, we'll make sure the RealAlt team gets back to you as soon as possible. But PT asks, are you able to invest in Series M through self-directed investing accounts with major Canadian financial institutions?
Yes, you could do a self-directed major financial, but they have to be registered with us as an AMD and we have to be on their platform. So that is the thing, we have to work with your institution. It depends whether their institution is there, but I would recommend them to come directly to us rather than going to a financial institution because they will have their own carve-out fees. We'll charge you a fee for that.
Right.
So,
that makes sense. The specific institutions they list are RBC and TD, just for your reference.
Yeah, RBC and TD, you have to be listed on their portal. Once you're listed on their portal, then they will recommend you. But I would recommend why do it? We are already giving you a first-hand experience on the asset. So that way you can put your money directly in the fund and save your fees, administrative fees to these high AMDs like TD or RBC.
That's helpful. Who doesn't like saving a couple bucks? One question I usually like to conclude these kind of things on, which is really just to ask you both, what are you most excited about at RealAlt over the next 2 quarters? What do you think gives investors the most to be excited about?
Series M.
Yeah, Series M.
Series M is the best thing to invest in. Looking at the Bank of Canada interest rate changes, looking at the market, we anticipate we'll get a lot of deals in distress and we are going to buy them out at a cheaper price. The investor waits out for 2 years and after 2 years he gets a higher return. So it's a very old-fashioned way. You buy low and you sell high. It will be the case of Series M. So, yeah.
Appreciate when there's a clear answer to that last question. Sometimes I surprise people. Appreciate that very much. I think that's all the time we have for today. I'd really like to thank Shezan and Tracey, both of you, for talking with us today and providing your insights and experience, as well as a detailed overview of RealAlt's products. And keep in mind, this is recorded, and we'll be able to get back to you quite soon with any additional questions that you've got. But with that, I'll hand it back to Shezan and Tracey for the final word before we wrap for the day.
Thanks for your time. Great questions. So the next presentation, we will be bringing in a few more of our senior people too, so you can better understand our company. I think when you invest, you need to be informed. You need the facts. You need to trust the people as well. So next week we'll also be have more staff here, so you can get to know us even more. And please bring us your hard questions. Thanks for your time.
Awesome. Thanks so much. Have a great afternoon, everyone.